So if you are one of the, I don't know, millions of people who've been trying to buy a home recently, or maybe even just thinking about refinancing, the absolute choke point for the entire market right now.
Oh, yeah. It's impossible to miss. High mortgage rates.
High mortgage rates, they're the single biggest factor keeping so many would-be homeowners just stuck on the sidelines.
Well, it's more than just a waiting game. It's a massive wealth drag. I mean, when the cost of borrowing money is more than double what it was just a few years ago,
Right.
it doesn't really matter if the economy is doing okay or if wages are going up. Affordability just collapses. You're paying so much more for the exact same house.
Absolutely. And that is exactly why we are doing a deep dive today into a major, and I mean aggressive, new directive from President Donald Trump. It's a strategy that's aimed specifically at lowering those mortgage rates by instructing two massive agencies, Fannie Mac and Freddie Mac, to become huge bond buyers.
Right. And we've synthesized a whole stack of recent reports on this. We're looking at the directive itself, the immediate market response, which was a little chaotic.
Yeah.
And most importantly for you, the heavy skepticism from financial experts about whether this financial muscle actually has any staying power.
So our mission today is to cut through the jargon. We're going to try and understand the mechanics of how this all works, specifically something called mortgage-backed securities, or MBS.
And then we're going to weigh whether a strategic $200 billion investment can really move an $11 trillion market.
It's a fascinating collision of politics, finance, and housing policy.
And for you, the listener, understanding this is essential. Housing affordability, it affects everything from your own budget to, broader economic growth. This is a big attempt at a direct fix.
Okay, let's unpack this. So the order itself, it came with very clear marching orders, a very specific dollar amount.
It did.
President Trump instructed Fannie Mae and Freddie Mac to buy up to $200 billion in mortgage bonds. What was the exact stated goal there?
The language was incredibly unambiguous. The whole point was to use this massive purchasing power to directly, manipulate the cost of debt. He said he was, and I'm quoting, instructing my representatives to buy $200 billion in mortgage bonds.
In all caps, I assume.
Pretty much. And the quote goes on. This will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable.
And we saw official confirmation almost immediately, right?
Yeah.
This wasn't just a political soundbite.
Not at all. The Federal Housing Finance Agency Director, William Poult, he confirmed on social media that Fannie and Freddie would, in fact, conduct these bond purchases. It's an active policy.
So to understand why this $200 billion figure even matters, we need to quickly break down the role of these two entities in this thing at the center of it all, mortgage-backed securities.
Yes, MBS. This is fundamental.
So, okay, when someone like you or me gets a mortgage from a local bank, that loan doesn't just sit on the bank's books forever.
Right. The bank wants cash so it can make new loans.
So they sell that debt off.
Exactly. The lender sells the loan to a huge government-sponsored enterprise, either Fannie Mae or Freddie Mac. And these firms, they do something really crucial. They pool thousands of those individual mortgages together.
Right, they bundle them.
Essentially chopping up all that debt into smaller pieces and creating a new investment product called a mortgage-backed security.
And traditionally, they sell those new MBS products to big investors, like pension funds or insurance companies.
Yep. And that cycle is the lifeblood of the market. It recycles cash back to the lenders so they can keep making more loans, and that's what's supposed to keep rates stable.
Okay, but this new directive, it flips the script.
It introduces a major shift in that cycle. So instead of primarily being aggregators and sellers of those bonds, Fannie and Freddie are now being told to be aggressive buyers.
So let's get into the mechanics here for a second. The goal is lower mortgage rates. If Fannie and Freddie start buying $200 billion worth of bonds, that increases demand for the bonds.
Which drives up their price.
Okay, so how does a higher bond price lead to a lower mortgage rate for me, the consumer?
That is the key financial relationship. So bonds trade on something kind of yield. You can think of yield as just the interest rate an investor earns.
Okay.
And bond price and yield have an inverse relationship. They move in opposite directions.
Wow.
So if demand for the bond is high, the price goes up. And because the interest payment on the bond is fixed, the effective yield that a new investor can get on that higher price is forced down.
Okay, so when these government-backed agencies flood the market with $200 billion in demand, They're inflating the bond price,
Huh?
and that pushes the yield, the metric that actually determines the mortgage rate, downward.
Precisely. They are injecting a ton of liquidity and basically increasing the perceived safety of these things, and that translates directly into cheaper borrowing costs for homeowners.
Well, based on the reports we looked at, the market definitely reacted as intended,
Totally.
at least, at
Oh,
first.
they absolutely did. Markets responded almost instantly at the news. We saw the benchmark 30-year mortgage rate drop on Friday to near 6%.
Wow.
According to Mortgage News Daily, that is a significant, very rapid move.
And that drop pushed rates to their lowest level since early 2023. I mean, that's real immediate relief for people who might have been waiting for just a small window.
It is, but we have to put it in context.
Yes. Let's zoom out. Even dipping near 6%, we're still fighting against an incredibly high baseline.
We have to emphasize that, despite this recent drop, rates have been stuck above 6% for what, several years now? And historically, even this lower rate is more than double what we were seeing earlier in the decade. I mean, people were getting rates under 3%.
And if we connect this to the bigger picture, this is why this directive, whether it lasts or not, matters so much to you listening. A rate change of even half a percentage point, that's tens of thousands of dollars over the life of a loan.
It immediately impacts your debt-to-income ratio, whether you can even qualify for a loan, your chance to refinance existing high-interest debt.
Right.
And the ripple effect goes beyond just the individual. Mortgage rates, they heavily influence demand, which affects housing prices. If credit gets cheaper, demand surges, prices often follow.
And cheaper payments free up consumer spending, which helps the broader economy.
Exactly. Interventions like this are always, always charged, both economically and politically.
So that immediate drop near 6% is the good news. But here's where the skepticism kicks in. This is where we have to really interrogate the cold, hard numbers. And the key question is $200 billion enough to move the needle in a lasting way?
And this is the core reason for all the caution we're seeing. It's the scale challenge. $200 billion sounds like a colossal amount of money.
It is a colossal amount of money.
It is, but you have to compare it to the total market it's trying to influence. We're talking about global financial markets here.
So how big is it?
The total mortgage-backed securities market, that entire pool of mortgage debt, is currently valued at an astonishing $11 trillion.
11 trillion. Okay, so let's just do that math for a second. You're ordering a $200 billion purchase.
Yeah.
In an $11 trillion market.
Right.
That means this massive intervention is aiming to influence, what, less than 2% of the total market value?
Less than 2%. The sheer size disparity is staggering. I've heard the analogy that it's like dropping one Olympic-sized swimming pool's worth of water into the Atlantic Ocean. The ripples are immediate and you see them right there, but the ocean's inertia and sheer volume are so enormous that the long-term impact on the overall water level is negligible.
And that skepticism, it isn't just an abstract idea. It's coming directly from analysts.
Yeah, it is. Joel Berner, he's a senior economist at Realtor.com. He didn't mince words. He called any expected long-term impact modest and short-lived.
Modest and short-lived.
Yeah.
And his caution is based on historical precedent, right? We've seen attempts to move this market before.
Exactly. We have a perfect comparison point. The Federal Reserve's own actions after the 2008 financial crisis and their quantitative easing programs.
So how does this new directive stack up against what the Fed did?
Well, the Fed's own purchases of MBS over the years totaled $2 trillion.
$2 trillion.
That's 10 times the scale of this $200 billion directive.
10 times. So the concern from critics is that this is more of a signal, a strong political statement, than it is a genuine, sustained source of financial firepower that can change the rate environment for years.
And if the impact is only modest and short-lived, Berner raises an even more critical, almost self-defeating warning.
What's that?
The price feedback loop.
So you're saying a successful intervention could ultimately defeat its own purpose?
Potentially, and very quickly. Here's how it works.
Yeah.
If you do successfully push mortgage rates down, you immediately bring a ton of previously locked out buyers back into the market.
Okay, a surge in demand.
A surge in demand that hits a housing market where inventory is already historically tight.
And basic economics tells us that huge demand chasing very limited supply.
Pushes home prices higher. So the relief you got from a cheaper monthly mortgage payment is immediately erased by the higher price tag on the actual house.
So you just shift the affordability problem from the interest rate column over to the principal column.
You're just swapping one problem for another. The policy tries to solve the symptom of high rates, but the underlying disease of low inventory remains, and the cure for the rates can actually make the disease of high prices even worse.
And there's one more piece of context here, right? Fannie and Freddie were already doing some of this.
That's right. The directive is really more of a mandated acceleration of an existing trend. They were already increasing their MBS holdings, reaching almost $234 billion by October. So this order just forces them to do more, faster.
But now we need to introduce what might be the biggest paradox in this entire situation, a major policy conflict.
Yeah, this is a major point of, let's call it policy schizophrenia. Because while the administration is ordering Fannie and Freddie to buy bonds to lower rates now, they've also been floating a separate, long-standing proposal to end the government's control over them entirely. In short, to privatize them.
That's the crucial detail most people forget. Fannie and Freddie, while they're technically publicly traded, have been operating under a government conservatorship since the 2008 bailout.
They're essentially wards of the state. The Treasury holds a majority stake.
And that's where the conflict comes in.
Here's the rub. Analysts warn that if you move forward with that privatization plan, if you remove that government backing, you could actually push mortgage rates significantly higher.
Wait, why would removing the government safety net drive rates up? That sounds backwards.
Because the government's backing is what guarantees the stability of those MBS securities no matter what happens in the housing market. That guarantee keeps borrowing costs for Fannie and Freddie low.
Okay.
If you take that away and they become purely private companies, the market is going to demand a higher risk premium. And that premium gets passed directly to you, the consumer, as higher mortgage rates.
So on one hand, we have a $200 billion directive to make housing cheaper right now. And on the other, a threat of privatization that analysts warn could completely undercut that entire goal and drive rates back up in the long term. It just creates massive uncertainty.
It does. It forces everyone to weigh these short-term orders against the possibility of a complete, maybe destabilizing structural overhaul down the road.
And it's vital to see that this MBS directive wasn't happening in a vacuum. It was part of a broader housing strategy that week.
Right. This bond purchase order was the second significant housing move that week.
The other plan, announced just a couple of days before, was a proposal to ban large institutional investors from buying up single-family homes.
And that policy is going after the other side of the equation. It's an acknowledgement that these large investment firms buying hundreds of homes at a time to rent them out are fundamentally changing the market.
Right, they're competing directly with first-time home buyers.
They can pay in cash, they can move faster, they outbid individuals, and that just makes the inventory crunch worse and drives prices up for the average family.
So we've got a two-pronged strategy here. The MBS directive is trying to address the cost of borrowing.
And the investor ban is trying to address the competition and availability of the houses themselves.
Both moves are aimed at the same goal, making housing more affordable in this crazy market.
They're just attacking the crisis from opposite ends.
So what does this all mean? We've seen a clear, aggressive attempt to directly influence borrowing costs. And it worked, at least for a moment. Rates dropped.
But that short-term win is heavily tempered by the sheer scale of the market. That $11 trillion ocean is just really, really hard to move with $200 billion. The Fed's $2 trillion interventions really put that into perspective.
And on top of that, we have that fundamental internal contradiction. Lower rates today, but maybe privatized tomorrow, which could reverse all the gains.
Ultimately, the sources really highlight this dual crisis in American housing: the cost of money and the lack of supply. One policy hits the rates, the other tries to hit the inventory.
And the provocative thought we want to leave you with is this. Which of those two major drivers of affordability, interest rates, which can be influenced by government orders, or the overall housing supply and price, which is driven by things like population, building rules, and investor appetites, which of those will ultimately determine whether you can actually buy a home in the next few years?
Which factor is the hardest, the most entrenched, and the most resistant to move?